And welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mix and journey towards financial freedom, financial well-being, financial products so you, like me, can reach your goals sometime in the future. Now let's get into this latest video. Now this video is about my self-invested personal pension plan for the month of November 2023. Now I do have a workplace pension, but I'm restricted on the contributions I can put in and the funds I can invest. So I do my own pension in a Sipp so I can control 1, the level of investments, and 2, the funds and investment I hold within that portfolio. Now the aim of the portfolio is an annual return of 10%. For dividends during 2023 we're looking for £4,500 and a year-end valuation of around about £117,000. So how have we done in the month? Well, let's look at the following chart. We started the month at £99,408, up about 2% year to date. Very good recovery. We're now at 105,660, profit of £6,252 a month, year to date return of 8.72%, so nearly at the level we started way back in January. During the month we made normal contributions of £200 on the first of each month, and our platform provider or our tax relief claimed £50 as a basic rate tax bill on our behalf. And our monthly fees were £14.72 based upon a percentage of our portfolio value, which is about average during the past few months. And where is the portfolio held, shall we say, on a geographical region? Predominantly UK and Europe, 81.8% in those sectors, 15.69% in USA and Americas, and 2.51% in Asia and emerging markets. Now during the month we received no dividends, which is quite unusual, but just the way that obviously the payments are made. Across our 15 shares, our yield is an average of 4.34%. Now year to date we've received £4,204.81. So we're over about £80 above our expectations, but we do have a good month in December due. We've got 4 dividends plus any funds, shall we say, payable in the month, so the figures will increase and hopefully we'll reach our year-end target. Now let's dive into what sort of holdings we have within our portfolio. When we started out, we were picking our own shares, we were picking our own funds, but we were predominantly, shall we say, based in UK shares because of what we know about. At the moment, our shareholdings are worth £80,833, makes up 77% of our portfolio, of which 68% is in the FTSE 100 and 9% is in the FTSE 250. Now we own 15 shares, 8 in profit, 7 in loss. Quick look at the graphic, shall we say, of where our holdings are. So our largest holding is Aviva, 4,655 shares, nearly £20,000, 18% of our portfolio. Safe Secure we just switch off, given a nice yield around about 7-8%. Is cash rich, shall we say, has been on a buying spree lately after recent restructuring, but our long-term hold we can just switch off. Our next holding has struggled lately, but the results have been good. It's Lloyds the Banking Group. 36,162 shares, £15,000, nearly 14% of our portfolio, giving a yield around about 4 to 5%. Again, banking sector has been affected last 12 months, but the results were very good in the last quarter. Our next holding is up 100%. It's Greggs the Bakers, 283 shares, £7,000, 6.6% of our portfolio. It's very cash rich on a expanding, shall we say, expansion plan. It's gone away from the retails, or shall we say the shops, but it's gone to more forecourts, shall we say, petrol stations, shopping centres. And it is doing what we call late night deliveries, late night openings, and it has changed its menus recently, but a very cash rich company, and we're up 100% since we bought that share several years ago. Back on the banking sector, we own HSBC, 1,135 shares, nearly £7,000, 6.5% of our portfolio. We'll pay a quarterly dividend in December. We'll pay a special dividend at the start of next year when operations are sold within Canada. But it was done for diversification, is giving a very nice yield of around about 6%. Our next holding is quite selective, shall we say. It's Drax, the biomass or the pallet maker. 1,254 shares, £5,500. We were up 100%, have struggled during the last few months, shall we say, for the energy sector and tariffs, but it still makes up 5% of our portfolio, and it does pay very good dividends, is cash rich, and it has been on a buying spree recently for a long-term hold. One holding we've increased recently is Legal & General, the insurance company. 2,098 shares, nearly £5,000, 4.5% of our portfolio, but it is giving a very nice yield of 8%. Just like Aviva, just switch off. Everyone needs insurance, makes some great money from premiums, but it has, shall we say, does have a lot of money in the investments and the pension sector, which we know about. Next holding has struggled recently, it's Barclays, the banking group. 3,088 shares, £4,500, 4% of our portfolio. Not the greatest result the last quarter, but again is cash rich, is making a profit, and the dividends were increased. But it has struggled, shall we say, because of its investment arm in recent months. One share that has done well though is JD. We own 2,500 shares, up 100% since we bought it. £4,000, 3% of our portfolio, is very cash rich, had £1 million in cash, and it's just been expanded in Spain and Portugal, and it has got great presence in America, but it does pay a small dividend, but it's what we've seen as a growth stock. We own 1,233 shares in Sainsbury's, £3,500, 3% of our portfolio. Very good results recently. The dividend was held at 3.9p, but it will pay a nice dividend in December, and hopefully we'll have a very good run up, shall we say, with all its Christmas shopping. And then we have two shares within the oil sector. Shell, 150 shares, £4,000, and BP, 542 shares, £3,000, and they both pay quarterly dividends, and they'll both pay dividends to us in December. Has been affected, shall we say, by the oil price, but very cash rich, shall we say, and it does pay quarterly dividends, which we then reinvest within other shares within our portfolio. Other shares we note is Penn and the water company. We own AG Bar, the drinks provider. We own AJ Bell, the platform provider, and we own Card Factory, the retailer. So a collection of shares, but predominantly based on what we know. Safe, secure, steady companies will be here, shall we say, in another 15, 20 years, a lot longer, and they do, shall we say, adapt. But some are paying some very nice dividends. It's just we've not received any this month. Okay, now let's look at what sort of funds we hold within our portfolio. In our portfolio, we've streamlined it a bit. We now own 5 funds, 4 in profit, 1 in loss. Total fund holdings are worth £24,751, makes up 23.5% of our portfolio. Our largest fund is a Legal & General Technology Fund, £8,700, 8% of our portfolio, has had a very good run recently. It holds, shall we say, a collection of top 150 shares, mainly predominantly in the US, but it's done for diversification. Our next holding is a Fidelity World Index Fund, £7,500, 7% of our portfolio, and we did increase in the month with an extra £300 in our portfolio. Makes about 8 to 9% over the last 5 years annual return, and it's got very low fees of 0.12%. We can just switch off. It covers the market. It was done for diversification because we were, shall we say, solely UK based. Our next holding is quite selective. It's a badly given positive change. £3,400, 3% of our portfolio, owns about 35 to 40 stocks, or shall we say in ESG or sustainability. We own a Linsell Train UK Equity Fund, £2,600, 2.5% of our portfolio. It was done for the track record, so it owns some very companies within the UK and Europe, but very select, all long-term hold and buys within the portfolio, but a great track record by the management. And then finally, we own a Global Growth Fund, our only fund in loss. £2,400, makes up 2.2% of our portfolio. Hopefully it will recover, and when we're back in profit, we may well put that money into our Fidelity World Index Fund, one, to save on costs, and hopefully it's got a much better track record than paying for active management. But as we've said, a collection of funds makes up £25,000 of our portfolio. It was done because we were, so we say, solely UK based. Now, these are my own opinions, okay? We show no reason why we're going to sell any shares or holdings within the foreseeable future. We can just switch off, and as we said, every month we reinvest in dividends. Every month we're buying into an existing fund because of cost basis, but it's hopefully going to meet our objectives for this year thanks to a very good run recently in November after some kind of recovery. Hopefully that momentum will carry on in December and we'll reach our targets for the year end. It just goes to show, though, shall we say, if you take some steps, if you take some action, you create a plan, reinvest your dividends, make contributions on a regular basis, you too can build a sizable portfolio. Now, it's not to boast or brag, but say, well, if I can build a portfolio of 6 figures, you can too. It may take you a few years, but it just goes to show, if I can do it, you can do it. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.